Today I'm going to be reviewing Euro USD on the 1 minute time frame. I'm going to do a historical review as far as my plan will let me, and I'll see where my optimal entry points were for my strategy and what the outcomes of these strategies would have been, these trades placed. So let's go all the way back here. Alright, beginning of time, right here. Here's our first trading day. Right? Let's zoom in here. Alright, we can see this strong bearish movement down. We had this huge swing break of structure. We know market is most likely going to trend down. There's a lot of active supply over here. This whole section here is one big active supply zone in the higher time frame. So we can see price enter this area of high seller volume. And what can we see in accordance to our strategy? Right? We can see price come up, come down, come up again, come down, fail to create a higher high, come down and make a lower low. This is important to our strategy because this is our validation of a swing point. This is step one of our strategy. Swing point has been validated. So now there is resting liquidity that we can tap into above this high. So we can place this here. Price comes up, sweeps this point, and then it comes down to give us an internal market structure shift. Right here, right? And this is our three-step model, as simple as that. So we get our internal market structure shift, this candle closes, and what can we do? We can enter our short position, right here, simple as that. This becomes our, I guess, micro protected high, so we can use this, factor in our ATR value, and shoot for our 1-to-1. Simple as that, right? Let's see if anything else happened here. Okay, we can see this here. We can see price came up, broke structure, pulled down, gave us a small pullback, and we can see price just wick above here, right at this point. Price wicked above. Valid liquidity is being generated from all these early buyers thinking this move is continuing. Market comes down. The institutions slap these traders out of these trades. And then what happens? We can see a very, very small internal market structure shift. We get a candle close above this point. Now, since this point has swept liquidity, this becomes our strong low for this small scenario. Enter on there, fake stop, ATR true stop, and we shoot for our 1-to-1. Guaranteed profit. You're in and you're out of this trade in like 15 minutes. That simple. And usually I try and keep this as minimal as possible. With these trades, I try and do 2 trades daily. 2 good clean setups every day. I think that is a very good consistent number, and honestly I really don't think you should be trading any more than that. If you are trading like 40-50 times a day, even in my opinion like 7 or 8 times is way too much, right? I think that develops unhealthy trading habits, and that can also force revenge trading, right? Okay, so let's see here. We can see price, our session opens 8:30, price comes up, gives us this internal break of structure, pulls back into this demand, pushes up, breaks structure again, pulls back into this demand, pushes up, breaks structure, kind of consolidates for a minute, and breaks structure here, right? This validated this swing low. Just like this validated this swing low. When market breaks structure or even wicks above like this, it is showing strength and liquidity under those higher lows, right? So we can see price accumulated a bit. It even induced this point too, so it validated this point as a swing, right? So this point here swept, this point here swept, and then we can see our larger internal market structure shift on this candle right here, right? So since this bottom has swept liquidity, this becomes our strong low. So we can take the bottom of the pivot point here, add our ATR value, right? Set our stop, and then go for a simple 1-to-1. There, hit again, right? Like magic. You don't need to be constantly trading with this model. This model is designed to be quick and consistent, right? You're not shooting for these higher risk to reward ratios. You're not taking trades every 5 seconds because you think that it may be valid or just only 2 steps are missed. It has to be a consistent effort with this strategy, right? Let's take a look at what happened today, or not today, this day. Huge dump here right in the morning, 8:30 news. Market consolidated a bit. The consolidation pulled up, kept pulling up, breaking this structure. And here we can see almost this consolidation, right? We can see price consolidate, pull up, pull around, but all these swing points here, even this one, they're both valid swing points, right? So we wait for the validation, which we received right here when market pushed higher. Same with this point as well. Market pushed higher. Then we can see market comes down, takes our points, takes our swing points right here and right here. And then what does it do? It gives us an internal shift of market structure right here, right? Internal shift of market structure, and then market takes off, right? Plain and simple. We enter on our market structure shift with our protected low, ATR value factored, and then simple 1-to-1. And as you can see here, for example, our take profit got completely obliterated. You could have shot for 1-to-2. You could have gone for these resting news highs over here, these data highs. You could have gone for maybe even a 1-to-3. But we don't do that. The way we trade this model is supposed to be so we can trade almost every day consistently and secure that 1%, right? Because if you're going to consistently start shooting for a 1-to-2, then every day you'll start shooting for a 1-to-2, because in your mind you'll start to think, oh, this is a much better risk to reward profile. I'll get way more return on my risk. But when that risk to reward starts not getting hit, the model starts to lose its consistency, right? Same thing up here. We can see a push up, a pull back, a push up again, consolidation, and then we can see market pull back again. So it gives us the validation of this specific swing low right here. We can see the market come down and sweep this swing low, and then we can see the market give us a shift, right? This becomes our liquidity low, our protected low, and then we can enter on the shift, right? We factor in our ATR value, whatever it may be, and we go for that safe 1-to-1. Okay. Even after my session ends, I stop trading at New York lunch. You can still see it happening here. Validation, sweep, another sweep, and an internal market structure shift. 1-to-1. Hit perfectly. Right? It's all about trading within the session. The session I trade this model is 8:30 to noon, right? Eastern Standard Time. And that's it. I'm in and I'm out. And then I'm in and then I'm out again, right? That's simple. Now this one here, this one could look more complicated to newer traders, especially people who don't really understand liquidity points and stuff and really what to look for. This can be kind of confusing, so we'll follow this trend here, right? We got a large market structure shift with this huge demand created, lots of volume coming in here, right? Lots of institutional orders being placed. And then we can see the market pull back, pull back, pull back, creating these lower high, lower high, lower highs all over the place. And then we can see the market come up. And then we can see it come up above this point here. And what does the market do when it comes up above this point? It validates this and this as liquidity lows, right? So we wait for a break of these lows, which we got right here. We wouldn't enter anywhere else. And then we see our internal market structure shift, right? And then comes in our safe 1-to-1. I'm telling you, this happens almost every day on Euro US dollar, and this is such a safe strategy to play that it is so consistent. That's the beauty of this, is it's so directly consistent, right? And yeah, that was the only trade that would have been taken this day, because everything else just kind of consolidated around, you know, slowly accumulated. We do not want to be in positions when that's happening. We want to be sitting back and watching how the market reacts. That's all we do with this model. It's all reaction based. We're not setting any zones. We're not praying that price taps into our zone. We're not praying that we get liquidity swept from our zones, right? Because especially on the lower time frame, the EU loves to sweep liquidity out of these order blocks, right? Because there's a lot of fake demand around here. And how do we know what is true? That's a whole other video, right? But yeah, here's the other one demonstrated. We can see market accumulate, strong bullish momentum upwards, consistently breaking structure, breaking structure, breaking structure. But right here, we can see the market come up, pull back, come up again, validating this as a liquidity low, right? And then we can see the market come down, sweep past this point, and then give us that market structure shift right over there, right? And then this one is a beautiful example of why we enter on a 1-to-1, right? So we put our stop at the liquidity sweep, factor in the ATR, and then we go for our 1-to-1, right? Hit beautifully, and then completely reversed on us. And then you might be thinking, oh, it came back. No, it didn't. It completely dumped after this. Would have definitely hit your stop loss the longer you held that position, right? And over here is an interesting example of how to play this too, right? Because now we can see this individual trend goes down, comes up, goes down again, comes up again, and pushes down before giving us a shift in market structure and reversing upwards, right? So what would we do in this scenario if we were looking to enter on a short position, right? We can see our liquidity highs right here getting ran through. This one here, and this one, right? We can see all these liquidity highs getting ran through. And this is also a beautiful example of why not to enter on an inversion fair value gap, right? You can see this fair value gap gets reversed right here after liquidity is drawn from this swing point. Liquidity gets swept. We get an inversion fair value gap right here. That's the signal to enter short, right? You put your stop loss above this level, and then you get smacked. Why is that? Because you didn't wait for the market structure to shift, right? So we see a second liquidity sweep of these alleged early buyers or early sellers, right? They get stopped out, grabs liquidity one more time before pushing down and giving us a strong internal market structure shift, right? Beautiful. This is where we would enter our second short position with our even more confirmed high, right? Our ATR value, and we 1-to-1. Beautiful. in and out very quickly, right? And that's a trading day. There's 1%, there's 1%. 2% is amazing to be up. I know it seems like a very small figure to a lot of newer traders, but 1% on a $200,000 account every day is $2,000. 5 trades a week is $10,000 a week, seeking that simple 1%, right? And that's the beauty of this model. Okay, so we can see price coming down, price sweep liquidity, and break structure. That's a pretty strong sign of a reversal, right? Market trends up, pulls back, trends up again, gives us validation of this swing low here, right? We can see the market come down and take this swing low and give us an internal market structure shift. Beautiful, right there, right? Now we want to enter our long positions right here with our stop loss low with our ATR and then our 1-to-1, right? Perfect. Did we see any other entries on this day? Yep, one right here, right? We can see market come down, come down, come down, strongly push up, pull back, strongly push up again, validating this swing low. The market comes down and stops out these early buyers, and then what does it do? It gives us a strong internal market structure shift right here, right? Another beautiful example of why 1-to-1 is important. Our swing low, ATR, 1-to-1, perfectly touched our level and then dumped, right? Let's see if there's any other entries. I'll do one last one just to showcase this, and then I'll calculate the return, the win ratio on what I just showed you on those previous trends. And here's a good example of what I talked about in the other video, where even if we are wrong, we can still profit from this model, right? That's why I don't really believe in the use of a strong daily bias system. So we can see price come down, validate this swing high. This is a valid swing high because the market wicked lower. Then we can see price come up and take this swing high. And we can see an internal market structure shift from this point, right? Short position right here. ATR value, stop loss about there. Beautiful 1-to-1. Absolutely beautiful, right? Because what happened right after? Stopped out. And then the market continued to trend way higher, right? So we still profited from our mistake. So then we can see market come up, break structure right here. That order flow is continuing making higher highs. We know we're now in an uptrend, right? What can we see here? We can see a break of structure right here, a wick up, especially above this point, and this point as extra confluence, right? So this validates this swing low quite strongly, right? This double shift in market structure. And then we can see price come down and take this low right here, right? It stopped out these early buyers. And then we can see price come over and then give us an internal market structure shift. This is where we enter our 1-to-1 as usual. Beautiful. Tagged out right away. And then right here, what can we see? We can see price come above, validate this swing low, come back down to steal the liquidity from this swing low with this strong candle here, and give us an internal shift in market structure. And again, our 1-to-1 would have tagged beautifully, and that would have been it for the day, right? This is a beautiful method of trading that I have found to be the most consistent. If you want to try this for yourself, I found it to be the most profitable on the EUR USD 1 minute time frame. On higher time frames, a lot of this just doesn't add up the way we'd want it to on a lower time frame, right? We don't get as many opportunities, we don't get as precise entries, we don't get what we want to get from this strategy, right? So let's see how much I would be up percentage-wise just these past few trading days, specifically trading this model. 1% risk on every trade, there's plus 1%, 2%, 3%, 4%, 5%, 6%, 7% or 8% or whatever. We would have been up colossal this week if we actually traded this model, right? And I know with days like this, especially, this was a tough one. We can see that if we would have just entered there and held and held and held, we would have gotten almost 6R return off of this trade, right? It's hard. It really, really is difficult to deal with the mental capacity of having to let go at such a low point. But as you could clearly see in these other trading days, only trading this model, the one-to-one is what saved us, right? The one-to-one is how we securely took our profits. Okay? It's that simple. It's really, really that simple.